Well, hello, everybody, and welcome to our January monthly webinar here at the Minneapolis Area Realtors. Uh, some of you may have noticed a couple things lately. One, you might notice we just closed out a year. 2022 is over and in the rearview mirror. Some of you may have also noticed that there have been some shifts in the market taking place that we are going to talk about today. So welcome. Thanks so much for joining us. Really glad you're here and excited to nerd out on some market stats with you. So with that, let's get trucking. Okay, so I like to start on a note of levity. Here we are, 1984, Brave New World, and Fahrenheit 451. We're somewhere in the middle of this Venn diagram here. Thought this was another interesting one just from a couple weeks ago. I know we're back in the freezer this week, but I thought this one was interesting on the map. They did not even really have a color for how cold it was going to be here. It felt like minus 58. And you can see that the white, the very cold, and they didn't even really have a color. Yeah, we need to cover up, but they didn't even really have a color to signify or denote just how cold it would be. Okay, quick outline, guys. Let's jump in to a little bit of an intro here. We are going to talk a little bit about a historical view or historical approach. We're going to spend the bulk of our time in section 3, a market update, but we will also talk some market segmentation, prices, property types, construction types, you name it. And then we'll also discuss rates and inflation, and of course, the impact on affordability. And then we'll round out with a little bit on the economy and some demographic updates, and then an outlook and a Q&A if there are any Q's and A's. All right, so unless otherwise noted, this is going to cover residential listings as coming out of Northstar MLS. We include single family, townhouse, and condo. We include new construction and previously owned, and we use almost all MLS data with a couple exceptions, such as income and some of our affordability indices. And those come from either Census or HUD or some other resources. Some of you might have also noticed there's not a lot of guarantees in this world, right? Not a lot of guarantees nowadays, but I'm going to make you one. You're going to feel overwhelmed in an hour from now. You're going to feel overwhelmed. You're going to feel like this guy showed me lots of charts. You will feel like you are drinking from the fire hose. You will feel information overload. You will feel the wargle. Okay, so just know you're going to be drinking from a fire hose. We will send out the charts and the slide deck so you can kind of spend a little bit more time, thinking through the content or, clipping it to use on social media or what have you. So just a little bit of a warning and a promise, and also a little bit of encouragement there. Okay, without data, we're just another person with an opinion. Right, so W. Edwards Deming coming through with that thought. Without data, you're just another person with an opinion. Don't just be another person with an opinion. Bring some data and some hard information to the table, and you will find you will achieve your objectives quicker and more easily, and you will keep your clients better informed and making better decisions, which will help grow your business and your trust. So we're drowning in information, and yet we're still starving for wisdom. So information is everywhere, but how to make sense of it, how to get it straight in our heads, how to apply it in the world and in the market and in our business. And so just a few other things to consider there. Okay, a historical view. The year is 1937, Sunday, April 25th, 1937. Be a homeowner. These are the best values offered here today. I'll just call out our attention to one of these, and the property is 3809 Longfellow. You guys have seen me call this one out. No particular reason I called this one out, just an example. And I mean, people know the Longfellow neighborhood, and they know this kind of home, and just thought it was pretty interesting. They're asking not even $3,500, $3,450 for this home, this structure. It's 38th and Longfellow. They're asking for about $350 down, and you pay $30 per month, just like rent. It includes interest and principal. My favorite part is this house has 5 rooms and a frame. The house is framed. That's how it's standing. It's framed. That's a good thing. It's good that the frame comes with the house. Otherwise, it would be a pile of sheetrock and shingles and pipes and vents. Yeah, so kind of an interesting one here. My oh my, how time changes, how time changes things. Let's keep strolling down memory lane here, kind of going through history. So here, fast forward a little bit, well, a good bit, just about half a century, and you'll see we are here in 1982. And when you guys hear that, inflation is about as high, or, is high, well, excuse me, not about as high. When we hear inflation is as high as it's been since 1981 or 2 or the early 1980s, well, this is the period that we're talking about. And you guys will notice, let me draw our attention. Where am I drawing our attention? Regular conventional, that's where we're drawing our attention. So rates starting at 18% with a point, you can buy down to 16 3/4 with 5.5 points. This is from Mr. Jim Duffy. Some of you might remember him. If you care to do so, or you're able to, feel free to page him at 538-1709. Again, page Jim at 538-1709. Guys, listen, when we heard people complaining about 3.5% interest because they heard someone get 2.9, and then people were complaining about 4.25% because their brother or sister got 3.4, and then we touched 5.5, and then we touched 7.3, and now we're 6.1 or 6.2. Guys, we are so far from the 18% interest seen in the early 1980s, the last time inflation was this high. Just good to keep things relative. Good to kind of make sure we're appreciating that historical perspective, and to put the present day in context, and to put sort of today's dynamics in context with history. Relative to what? Everything is relative. Relative to what? Well, we have to put that benchmark in there. Oh, by the way, speaking of benchmarks, so that was kind of a high water mark. That was a max over the last half century. How about if we do an average? Any guesses out there? Okay, I'll just tell you. Long-term average, more like high 7s, or just about 8%. So we touched 7.1 or 2. We're back down to 6.1, 6.2, 6.3. Could be 5.5 by summer. We'll talk about that a little bit, but that'll be really interesting. I think that'll inform kind of how this year goes, is whether or not rates can touch 5.5 by late spring, summer market, kind of during the busy selling season. Anyway, let's keep strolling down memory lane here, going back to 99. So kind of inching our way into the present, if you will. And what you're looking at here is month supply of inventory. So you'll see buyers markets up here in blue with more than 7 months of supply, sellers markets down here in green with under 6 months of supply. So, some call it 5 to 6, others 6 to 7. If you've got between 4 and 6, or, really anywhere between 4 and 7 months of supply, is a relatively well-balanced market. Obviously, toward that 4 mark is going to be a tighter market where sellers are favored. As you get towards 6 or 7 months of supply, you're starting to get into that point, that tipping point where buyers are favored a little bit, where buyers have the negotiating power and the leverage. I show you this partly for that, what I just mentioned, but I also show you this to kind of highlight exactly what's happened. And again, putting it in a historical context. So this is the leg that we're all worried about. This is the leg of the W. You guys will see the W here. You guys will also know that, for a while we were kind of making, the W was kind of leaning. It was kind of leaning to the right, I suppose, this notwithstanding, but we were kind of making lower lows and lower highs. I suppose we flatlined a little bit and then way lower highs, lower lows, lower highs. And now suddenly we're kind of making these higher highs. So this leg of the W was higher than its sort of starting point of the W. And so this is what everybody's kind of up in arms about. I guess in a way, there has been a change, there has been a shift, and we know shift happens. And so, I think it is worthwhile to call that out and to point it out and to think through what it means and, what's going to happen moving forward. I also think it's worthwhile to say, listen, even with this leg up, even with this change, we are still pretty deep into seller's market territory. So this is national, and they're showing about 3-4 months of supply. Locally, we're only about 1.5 months of supply, and that's up from 0.9 during the worst of the pandemic. So, I mean, we don't even have 2 months of supply. So we're still in seller's market territory, even though we did see this leg, make a higher high. We did see a gain here. We did see an increase. And of course, that reflects the fact that demand is way down and supply is down, but supply isn't down as much as demand. And that means that there's a few extra listings left over in inventory or left over under active status at month end. And that's why we show some of that inventory growth. All right, the real estate cycle. From expansion into oversupply, into recession, into recovery, back into expansion and oversupply. And so sort of what are some of the hallmarks or signatures of these different cycles, or I should say of these different points or phases in the market cycle? We won't go through all of them, but I think this is a useful tool in our toolbox that kind of helps us think through kind of where we're at in the cycle, where we might be going, how this is going to be different than 06, 07, 08. I suppose 09, I should expand that out a bit. One question, we were just in expansion. You could almost say we were in overheating, right? But we're not in oversupply. So typically when you see this kind of growth in the market, you see builders and investors kind of coming in and you see this excess supply because they're trying to cash in on this growth market. And then you see, when the growth or the demand slows down, either from rates or from, layoffs or whatever, then you still have this new supply coming on, and that gets us into oversupply, which then means prices have to come down. I like to use the analogy here in Minnesota. What happens if come October, Macy's or Nordstrom still has a lot of two-piece swimsuits? They're not going to be selling a lot of two-piece swimsuits in November, December, and January. So what they have to do is they've got to cut the price in half and throw it on the clearance racks. And that's how they clearance it out. So when you have an oversupply of something, prices usually adjust downwards in order to get the market back in balance, back into stasis, back into equilibrium, right? Some might call it equilibrium. So here's one question. We've been in expansion. Can we skip oversupply and go from expansion into recession? I don't know. I don't know the answer to that. I suppose anything is possible. Yeah, anything's possible, but really hard to see us going into this territory. Really difficult to see us getting anywhere into oversupplied territory. So every few years or decades or cycles, something comes along that sort of, I wouldn't say it nullifies the rule, right? Just because we have an exception to the rule doesn't mean the rule is null and void. It just means we've gotten an exception. And there's a lot of different reasons and explanations for why this time is so different. But thought that would be a useful little tool for us. Okay, so this one is the Great Mean Reversion. I like this one a lot. So this looks at average sales price in blue. And then you guys can see this channel. This is where we'd be if we were just growing at 5.5% year over year over year over year. So this is where we'd be if we had that average growth. Now check it out. In 06, 07, during our bubble, we were well ahead of that growth channel. And so when the market kind of crashed and we went into, economic recession and housing market downturn, well, we had to pay that back. So this was our party. This was our hangover. You'll also notice now we're not above the channel. So where we are now is not consistent with a bubble, right? It's just not consistent. And our supply levels are also not consistent with a bubble. However, you can see that we actually did kind of catch up and get into this lower bound of the channel. So we just kind of kissed that lower bound in 21. And then in 2022, we technically crossed it just barely. So this one goes back to 1960, kind of some interesting history here as well. Housing market activity, new listings and closings. This one also goes back to 1967. Forgive me, I meant to update that. This goes through 20. Oops, guys, forgive me. This goes through 21. Next one. I've got another one that'll go through. So you guys can see, look at our supply driven bubbles, early 90s and then in 06, 07. Look at how many new listings we had heading into those market cycles. Look at this growth in supply. How about on the demand side, closed sales in orange? Well, we saw demand kind of coming along for the ride for the time being, and then Lehman collapsed and everything else, and folks got laid off, and we kind of know what happened from there. And so the demand cratered. Well, you had all that supply. Those units had to have prices reduced or slashed in some way, and that's how we cleared that excess supply out of the marketplace. Notice how tight things are now. Anyone who says we're in a bubble, I just have to show them this and say, we don't have the oversupply that we'd need to be in a bubble. We simply don't. All right, market update. Housing supply is structural. Housing demand is cyclical. We'll talk about this a little bit more. I really like this saying. Why is today nothing like 15 years ago, or the housing bubble and crash and Great Recession? Well, let's look at job cuts. Last housing cycle, 8 million job losses. Present day, we shouldn't say none. This is a couple months old. I know Microsoft has announced. I think Meta has announced. Wells Fargo announced it's losing some folks in its refi segment, because safe to say there's not going to be as much refi demand when rates more than double from 3% to 7%. So, maybe we should say, I don't know, 50 to 100,000, maybe 100, 200,000, some, but not many. And a lot of that is very recent. And much of that is concentrated in tech, just because of what's happened in the tech world. Quick aside, might be a decent time to go bargain hunting in the NASDAQ. Total jobs, 140 million versus 160 million this time. Big difference there. Subprime loans, very prevalent during the last cycle, virtually absent now. New construction, over 7.5 million and barely 4.5 million now. So a big difference in new supply coming on the market, in that new home supply entering the marketplace. Inventory, almost 4 million now, just over 1 million. That is a world apart. And mortgage delinquency, about a third of where it was. Call it 3.5 versus a little over 10. So just about a third of where it was. How about foreclosure rate? 4.5% versus about 0.5%. What is that? A seventh and eighth. Pretty small share compared to where we were. Annual existing home sales. So you guys can see sort of nationally, yes, we have come down from 21 levels and 2020 levels. However, we're really not that far below 2018 and 2019 levels. And I think it's worthwhile to compare us to a BC, to a year in the BCE, in the before COVID era, versus the AC era, the after COVID era. And you guys can kind of see where we are, relative to our past, or the national past. All right, I like this one too. This one kind of has a way of sort of splitting up the last few years, or segmenting out the last few years into three distinct periods or phases. So one, call it this pre-COVID era. Sales, minus 5-6%, plus 6-7-8%. No extreme change. And then enter COVID, right? March, May 2020, March, April, May. Look at what we saw happen to sales. We saw a pullback right away early on, and then we made that back, and then a whole lot afterwards, 20%, even 30-40% year over year growth in sales. Pretty incredible. And then phase three, the Fed came in, Jerome Powell waltzed right in and poured cold water all over that market. So these high mortgage rates obviously responsible for this third phase, where we do see a cooling. We do see declines in demand. So down 20, even 30%, after up 20, 30, 45%. So three phases, kind of normal, kind of a boom, and then kind of a little bit of a bust. National home price, we won't spend a ton of time on that. You guys can see, right, this was sort of that growth rate. Look at the last 2 years, though. Definitely see some accelerated price growth. All right, math, it matters. Median versus average. Here's our friend Jeffrey. Mr. Bezos walks into a bar. There are 6 people at the bar, each earning this salary. In walks Mr. Bezos, making $200 million a year. I think that's even pretty modest. Well, the average income for this group is $28.5 million. The median income for this group is just $65,000 because half made more and half made less. But the average sums all these together. It adds them all together and then divides out by 7, the number of people. Well, guess what? This sum is going to be sort of allocated to these other 6 folks. You tell me. I don't want to tell you guys what to do or what to think. Well, maybe a little bit, but you tell me, guys. You think 65K is a better representative, is a more representative figure for this sample? Or do you think 28.5 million is a representative figure for this sample? I'll just say this. There's 1 out of 7 records above average, and there's 6 out of 7 records below average. For the median, there are 3 below the median. Well, excuse me, 3 below that median and 3 above. I should really order these in reverse. I should go in descending order, not ascending, because it's a little confusing, the above and below thing. So I'll work on that. Let's make this a little bit more realistic. Here's $200 billion. So now the average income, 28.5 million to 28.5 billion. I just added on 3 more zeros. What did our median income do? It didn't move a penny, not a cent. It didn't have to, because half were still earning more than the median, half still earning less than the median. Zillow said my house is worth 400K, 150. I'll give you 150. CMA, Country Music Awards. No. That's comparative market analysis. All right, so home price appreciation rapidly moderating. You guys can see, look at that price growth, 25% year over year. You can also see sort of peak of the bubble, 04, 05, before the 06 sort of beginning of the bust. You guys can see this looks like the little tax credit in 2010. This was when sort of an early phase of recovery. You saw a lot of investors and flippers sort of descend on the market and really drive prices there. And then, we kind of matured into kind of a more normal market right after this sort of early phase of recovery. And then we had this pandemic thing, and you saw price growth exceeding 20%, still heightened at 15%. You guys can see, 5 to 7 is kind of average for us. 6 to 8, 4 to 7-ish, sort of right around that 5% mark. And that's before inflation, by the way. So after this acceleration in price growth, now we've seen a deceleration. Price growth is still positive. It's still above 0. It is not negative like it was here, but it is more like 6, 7% versus 10, 20, 25%. That's the difference. Okay, this is a new one, and I really like this one. So this one kind of speaks to the fact that housing costs are relatively locked in, at least the first P and I are. The second T and I are a little bit variable, but let's be honest, we complain about it, but it doesn't move that much. Maybe I shouldn't say that. I know some folks in St. Paul really got hit with some tax bills in the last few years that were really extreme. So I really shouldn't say, I guess, I shouldn't say that. Let me just say this. Overall, across the entire metro, we've done the data analysis, and we show that the average tax rate is about 1.21% of your sold price. So every 100,000 worth of house, about 1,200 in tax. $300,000 house will be spending about $3,600 in tax. Some $300,000 houses are going to be $7,000 or more in tax. Some $300,000 houses could be $1,200 in tax if you're, well outside of the metro or what have you. So take a peek at this. So here's your monthly payment on that mortgage debt. $2,300 a month, pretty static. Up a little bit from taxes and insurance, but not from obviously the principal and interest locked in. Now, look at your earnings growth. So this is the key, guys. Your monthly housing payments are relatively fixed, pretty locked in, but your earnings are not. They're not locked in. They literally are infinite. Don't let anybody tell you otherwise. Even though the average is, X% a year, the world is your oyster, as they say. So take a peek here. If we're earning this a month and we're spending this on housing, well, now our mortgage takes up 35% of our salary. But assuming our salary grows, as hopefully it does, I think that's the goal, that's the trend. Whether it keeps pace with inflation is another conversation. But think about it this way: your housing costs are fixed, but your monthly pay grows, and that means that your housing costs will take up a smaller and smaller share of your budget. You'll have to spend a lower and lower percentage of your income on housing, on your mortgage. So I think that's pretty interesting, a pretty compelling little data point to use with some of your buyers, maybe younger first-time buyers who are a little bit concerned about this. But rest assured, in a few years, it's very likely to be lower than that. All right, October close sales. Let's just tease out October, you guys. I know it's a couple months old. Let's tease out October. This is October of every year going back to 2003. Blue, the dark blue, this is actual sales. So that's what happened. We had our COVID boom, and then we had our high mortgage rate bust, right? So here's the sales growth, or I should say sales assuming that average growth, the sales level assuming that average growth. You guys can see this is linear. Pretty simple. This is linear because it actually was linear for a while. So I've extended that out. Now, the dashed red line, or I guess that is dotted, blue is dashed, I guess the dotted red line here, this shows one scenario of a possible forecast, right? Just one scenario of what the future might hold. Now, we looked at the chart called the Great Mean Reversion. If you guys remember that, over a long enough period of time, things kind of get back on track. That's why it's a mean, an average. It's like gravity. It's like Jupiter. It's got so much gravity around it. It keeps, pulling. Oh, wait, does Jupiter have the belt, or is that Saturn? Oh, gosh. Whichever has the asteroid belt. I think that's Saturn. Jupiter has the red storm. Maybe it's both. Anyway, it's like a big planet that has an asteroid belt around it, or an asteroid ring. It has so much gravity that, these asteroids can kind of, come and go within the orbit, but over a long enough time, they're going to kind of be sucked back into that orbit. Interesting analogy. Kind of went with it. Thanks for your charitable. Thanks for your charity on that. I'll do better next time. Anyway, guys, forecast dashed red or dotted red here. Here's one possible scenario. Listen, here's this average growth. Here's where we kind of are. Here's where we were. Over a couple years, we're going to get back on trend. We may undershoot a bit. We may overshoot a bit. Over a period of time, expect us to return to trend. Exactly how volatile that is, or what that looks like, or the timing of it, that's the unknown piece. All right, let's dive a little bit deeper, guys. So we're going to look at some December figures because, well, first half of the year was very different than the second half. And December in particular actually did start to show some cracks. And so I want to call out some dynamics that took place in December that are worth talking about. And then we'll kind of benchmark that against more annual figures, or maybe we'll benchmark in reverse. Anyway, we're gonna take the year in context, but we're gonna say, hey, even though the year did this, December did that, and that's a little bit different, and that should warrant our attention. So new listings down 11% in December. Look at the COVID boom in 2020 when everyone was buying a home. Well, guess what? You also had to sell yours. If you weren't a first-time buyer, as you likely were not, you had to sell your home, and that meant you had to list it. So influx of new listings when we saw when we also saw a huge increase in sales, and then we saw this downturn. Folks who have 3% interest rates probably aren't as likely to list nowadays as they were, and also just when they made that transaction, then they don't need to make it again. So we saw this huge increase, and then we kind of leveled out a bit. This is the lowest number of new listings for December, for any December of any year going back to 2003. December pendings down 27% to about 2,400. Now we saw that 17% gain, held on to some of that, not all of it. So there's our 27%. We should take this in context, you guys. We should take this with a shaker of salt, not just a grain, but a shaker of salt, or maybe a tablespoon. So maybe it's worth kind of looking at some of the pre-COVID years, right? Looks like maybe 3,000. So 3,000, call this 2,400. What's 600? So what is that? A little more like 20% versus 27. So, I do think it's worthwhile to just acknowledge that these are sort of exceptional years or exceptional months within the year. So something to keep in mind there. Yeah, closings, pendings, closings, pendings, closings. Pending's always a leading indicator for closings. That's why we love them. You guys will also notice during COVID, we had no trouble, no problem reaching new heights, absolutely setting new records for demand, both for the month and for the year. So, you can kind of see there's our 39% decline. Looks pretty extreme, but we should probably be comparing to a pre-COVID year, more of a normal year. And yet this is what happened. This is the year-over-year change, but we should take that with a tablespoon of salt. CDOM, cumulative days on market. Nice 90% increase in this one to 34 days, right? 18 to 34, 18 to 36 would be doubling. We didn't quite do that. So almost a 90% increase in market times, the number of days that listings spent on the market under active status. This is not list to close. This is list to under contract. So there's a difference there. Okay, so 45, 38, 36, 34. We went all the way down to sub 20, 18 and 19 days on market. And that's for December, which is one of the slowest months of the year. And then we got back to 34. Well, one thing I notice is, yeah, that's a big increase. But I think the other thing that you should notice is that's actually even with pre-COVID levels. So market times are flat from 2019. They're still even below 2016, 17, and 18. But yes, they are up from 2020 and 21. Median sales price up not even 5% to about 348,000. That 5% is the slowest rate of price growth we've seen since 2018. Looks like I need a little bit more padding, a little bit more of a buffer here between my source text and my x-axis anyway. So 5% price is still growing, like we talked about, still positive, but decelerating, right? No longer the 8 and 10% that we've seen over the last few years. PPSF, price per square foot, we're looking at about 185 per foot. If we were 200 per foot, then a 2,000 square foot house would cost, about 400,000. This one is a telling one. This one is educational. This one really, this was one of the areas where we could see some of the cracks kind of starting to form a little bit. So percentage of original list price received at the time of sale. So take a peek at that one, guys. 96.3, 26, that would be something. 96.3, down over 3% from 99.5. But actually fairly even with some of these pre-COVID years, right? So we had a 96.9, we had about a 96 even, a couple 97s. So this isn't really that out of line with these 3 pre-COVID years. It is out of line with the 2 COVID years, right? The 2 truly sort of pandemic years. Guys, I don't want to say, I don't mean to make it sound like we're done with it. We're not done with it. But obviously, the COVID impact was much more felt in 2020 and 21 than it was in 2022. I think the Fed was felt more than COVID in 2022. But you guys can kind of see these 2 COVID years really pies in the sky, right? Pies in the sky here. And then we kind of got back to normalcy. A little bit, I think we overshot a little bit because of what the Fed has done with rates. So somewhat understandable there. Okay, shifting gears, December inventory. Well, not shifting gears that much. December inventory, number of active listings, quite simply. Do any of you remember when we had over 28,000? I think there was a couple months where we had 35,000. I think it was actually May and June of 07. We had 34,000 properties on the market. Wow. Now we have just barely over 6,000. You could be slightly encouraged by the fact that that is at a 3-year high for December. That's true. That's factual. What's also factual and true is that inventory at the end of December of 2022 was almost 20% higher than it was at the end of December of 21. And yet it's just about even with 2020 levels. And perhaps even more importantly, it's still not just below, but well below 2018, really 2017, but especially 2018 and 19 levels. It is well below those levels. So yes, while plus 19%, I think is a welcome, is a bit of welcome news to buyers, especially frustrated buyers who have written, 10 offers and have lost, in multiples on all of them. So that is welcome news. We have seen some supply growth, but it does not mean we are in a buyer's market. That's the key, right? We have seen things loosen up a little bit. It does not mean we have shifted all the way to a buyer's market. It's simply not the case. All right, another kind of, I don't know if I'd say dramatic change, but well, yeah, I mean, 50% is fairly dramatic. Another sort of change indicator that, is captured in December is, of course, month supply of inventory, very much related to absorption rates. And you saw that 50% increase, right, from, 1 to almost 1.5. So up by almost half, 0.9 to 1.4 to be precise. So 50% sounds pretty extreme, and it is, but we still only have 1.4 months of supply. That is up from the prior 2 years, but still below pre-COVID levels. So I think there's this sense out there that, we're up here, that we're 3, 4, or even 5, or some seem to really think we have 8 or 10 months of supply. And, we talked about this a couple months ago, that we find ourselves in this standoff where, buyers think they're going to get deals, and they're going to lowball offers to, get their payments down to where they would be if rates were at 3 or 4%. And sellers think they're going to get prices from, a year or two ago. Well, as the saying goes, there's 3 sides to every story, side A, side B, and then the truth. So, I suppose truth as usual somewhere in the middle, but you guys can see just how this has changed. Up to about a month and a half of supply, still well below 4 to 5, 4 to 6 months. That would be considered balanced. All right, let's shift gears into some annual numbers, guys. We are running a little tight on time, so I may hurry things up just a little bit. Bear with me on that. New listings. We used to have 110,000, 100,000, 110,000 coming on the market. We had 68,000 last year. We had kind of flattened out at about 75, 76, maybe 77,000 for years, right? Many years in between that, call it 75 to 78 range. Then we kind of coughed back up 10% because sellers were not as interested in moving. They were staying put. Pending sales, right? And closed sales, pending sales, closed sales, pending sales, closed sales. Guys, let's talk about the closings. They're both demand. So 66,000, as we talked about, and this is annual, easily surpassed previous highs in 0405. We actually even surpassed those highs, I suppose technically not 2016, but 2017 at 61,306, right? That was a new annual high. So we hit a new record high for sales in 2017, and then we did a new all-time high in 2020, yet a new all-time high in 21, and then we had to, of course, give some of that back last year. So down 19% for closings. Here again, everybody, I think it's worthwhile to understand that these were kind of pies in the sky. It may make sense to use the 60,000 figure, as a pre-COVID level, 60, 61. So if we use 60,000, well, let's call this 54, 60,000 minus 6,000 to get to 54. It's about 10%, down more like 10% from a pre-COVID year. Looks pretty extreme. And yet, again, tablespoon of salt. Days on market. All right, so 11 up to 14 days for the year as a whole. So it's about 2 weeks. Down from 100, 115 days even. And yet, it is this 27% increase. We did see that 27% increase from 11 to 14 days. That's only 3 days. And it is even below 2020 levels, right? 3/4 of which was sort of a COVID year. And still well below, noticeably below pre-COVID levels, 2017, 18, and 19 levels. So 2 weeks on market, still a fast market, still a very quick market time there. But yeah, a little bit slower than in 21. That's a fact. That's true. Median sales price, looking at annual price numbers here. So we ended last year at 362.5, and that was up about 6.5%. And you guys will notice that is our slowest growth rate since 2019. Some of you may remember it was late in 2018 where interest rates did kind of, I think they hit about 5%. So that kind of slowed things down in the first and second quarter a little bit of the following year. And, sure enough, prices only really gained 5.7. We're now a little bit more like 6.5. But you guys can see, we've had some 10s, 11s, and 14s. We've had some 8s and 7s and some 8s and 11s. And now we're a little bit more like 6.5. Price per square foot, we just looked at, what was it, 184 for the month, more like 190 for the year. Yeah, to be honest with you guys, I don't love this one. Well, let me back up. I love this metric. This is a terrific metric, but I don't love this annualized view of it because I think it's missing something. The first half of the year really uplifted the second half. The second half would have weighed down this metric, while the first half would have sort of kept it afloat a little bit. So call this 102 down to 101% of original list price that sellers received at the point of sale. So 101, I think, makes the market last year seem a little stronger than it was, and yet it did come down, as expected. But remember, December was 96, you guys. So this 101 is very much skewed by, March, April, May, sort of spring, summer market. How deep is the mud? Well, it depends on who you ask. Ask our friends in Tampa, Phoenix, or Miami how deep the mud is, and they'd say, well, prices were growing 30, 35%, and now let's see, Phoenix is more like 10%. So if you're a seller who was thinking you'd be getting 30, 35% more year over year, well, the mud kind of feels deep, even though 10% is still really strong price growth. For us, well, our price growth got up to 15. Now we're kind of settling back into 7. So the mud isn't as deep for us, and we didn't climb as high, so we won't fall as hard. Just a few links where you guys can find some of that. Percentage of sales with a price reduction. So let's just pull out October, guys. Look at during the pandemic, during the heights of COVID, 2020 and 21, sellers did not have to make many price concessions, right? Or price reductions, maybe I should say, or concessions, both, right? So 20 to 30%, we see a 50% increase in the prevalence of price reductions, right? From 20 to about 30. And yet, price reductions are just about even, right? I suppose up a little from 2019, but down, compared to 2016, 17, and 18. So, yes, up 50%. That's true. But if you hear that on the media, I think what they're missing is that this is kind of back to pre-COVID levels. I just think that's missing. Let's look at this annually, sort of annualize this data. So 20% needed a price reduction last year compared to about 15.5 the year prior. And you'll notice that is even below 2020 levels and still, again, notably below 2017, 18, and 19 levels. Application. So how will I use this stuff? What's in it for me? Well, are we in a buyer's market or a seller's market? Month supply of inventory can answer that for us. How do the different property types compare? Townhouse, condo versus single family. Prices, up or down, median sales price, right? How long will it take to sell my house? Days on market, so on and so forth. There are so many different applications, listing presentations, opens, whether you're doing some prospecting and lead gen work. I always like to call out this one, personal marketing. Listen, the days on market in Wayzata is 82 days. My days on market for my listings in Wayzata is 31 days, right? Here's why you should go with me. I can use this data to market myself and show why I'm a better choice than my competition. A couple other thoughts there. Okay, guys, let's hurry into segmentation quickly here. And, guys, I know we're going to go over our hour. Whoever can stick around with us, we would very much appreciate it. But if you've got places to go, I understand. I know this says December, but look at these numbers. They're so big. They represent the whole year. This is year to date through December, or the rolling 12 months through December. Single family down 19%, condos down 20%, townhomes down 18%. So everything down, between 18 and 20%. I suppose townhomes were the, I got to stop myself, not the best performer, but the least bad performer. Closed sales by construction type for the year. So here's an interesting kind of breakdown. New construction sales down only 8 1/3. but existing or previously owned home sales down more like 20%. So down 8% versus down 20%. Well, I mean, yes and no. Maybe this is a surprise. I guess I was surprised that builders were able to get that much product online. Yeah, just given the ongoing supply constraints and everything else, labor, you name it. But I was also surprised that, buyers were willing, especially in the second half, that buyers were willing to, engage with this product type, that they were willing to do it. I think a lot of that is move up buyers, folks who are selling their 350 home and then looking at the 5 1/4, or moving out of Richfield or St. Louis Park or Roseville or Brooklyn Park or something, and looking at more of a Lakeville or a Blaine or a Rosemount or Farmington type situation. And again, maybe no surprise, because folks needed an extra bedroom. They wanted that 5th bedroom for a home office or a home classroom. Folks wanted, 2,800 square feet versus, 1,800 or 2,100. So we wanted that extra bedroom. We wanted a little bit more extra space for home entertaining or playing a little bit more at home or being locked down at home. So, maybe a surprise and maybe not a surprise. You guys will also notice we are still, the vast majority of our market is still a previously owned or existing market. You guys can kind of see the share or the ratio there. All right, let's segment the market out by price points a little bit. So this is closed sales, closings, or demand for sub 500K and then over 500K. So in blue is under 500,000, red over 500,000. So there's our decline, you guys. That's where our decline came, is under 500K. Well, guess what? The bulk of our sales happen there. So as goes that segment, so goes the whole market, if that makes sense. Take a look at this. This is absolutely fascinating. And, again, maybe somewhat surprising, maybe not surprising. These folks are pretty rate sensitive. A lot of first-time buyers, folks kind of shopping on a budget a little bit, maybe, some payment constrained folks. So when rates doubled on us from 3 to 7, these folks really started to feel it, and those payments just became out of reach. And so they pulled back. But for these folks who had equity from the first home, 100K, 200K in equity, you buy something for, 225, 5-10 years ago, and you sell it for 380 today. That's you did pretty well on that guy. So over 500,000, again, you see an almost 1% gain in sales, right? 0.8% of a gain. So still some growth. And that was after a 47% jump in activity over 500,000, followed by a nearly 1%. So we held on to those gains. And, I call this flat, plus or minus a percent. I guess I call that flat. Let's segment out price points a little bit more. So here's our same under 500K. This one is 500K up to $1 million. And then in green, we've added in $1 million plus. So you can't make this up, guys. 5 fewer. 236 to 231. 5 fewer homes out of 11,230. You can't make that up. Pretty close there. I call that very much flat. But over $1 million, we actually we tacked on another 7.5% gain. That's pretty crazy, right? And that was after a 51% gain. This market has been rocking and rolling. These folks are not rate sensitive. In fact, a lot of them pay cash. I shouldn't say most. It's about 25% over $1 million. As you get over 3 or 4 million, it does become most. Most transactions over 3 or 4 million are done in cash, especially over 5. So still growth over $1 million. How about our beautiful core cities of Minneapolis and St. Paul? Some folks expected the 2 core cities to have a much more dramatic decline in sales. Some folks expected St. Paul to have a more dramatic decline in sales than Minneapolis because of some policy changes that have happened there. And that did not pan out. So that would not be rooted in reality. And in fact, both of these markets, St. Paul down a little bit less than Minneapolis, but both of these markets down, about as much as the metro as a whole. So no meaningful difference in performance in our core cities relative to our metro area as a whole. Okay, deluxe. Luxury. If this doesn't scream luxury to you, I don't know what will. Closed sales over 1 million, guys. There was our 50% increase, followed by our 7.5% increase. Numbers are going to be just a hair different. You'll always see some late status changes trickle in. So you'll always see things move just a little bit, not much, guys. So what were we, 51? So 50 to 51 and 7.4 to 7.5. Not a huge difference. Let me also point out 500 to 1500, this market has tripled. I suppose it's taken a decade and a half, but this market has tripled. What's more impressive, even more impressive, be generous with me, guys. Give me a little bit of latitude. Call this 750, and let's just squint and turn our head to the side and call this 1500. 750 to 1500 is doubling in 2 years. This has doubled in 2 years. Holy cowbells, that's crazy. And 25% followed by 50 and another 7.5% gain. So that is the slowest growth rate since 2016, but still tremendous growth over the last few years. But some evidence of kind of leveling out a little bit. Days on market, million plus. Million plus used to spend 260, 270 days on market. Last year, 3 weeks, 21 days. 21 days on market, right? And 23, the year prior, down 66%, from 70 down to 23 days. So 3 weeks on market. And even with rates rising for most of the year, these homes, these luxury homes actually sold more quickly, sold in less time, sold in fewer days, right? So really just speaks to the strength of this segment. Another one that just really kind of blows my mind, but maybe it shouldn't because it's pretty consistent with the other indicators in this million plus luxury segment. Our percentage of original list price received at the point of sale rose 1.33% to 99% of original list price. 99%. Sellers in this luxury segment are used to 95%. 95% is a great year. That's a great level. 95%. 99% is unheard of, right? These guys used to accept 15% less than their original list price, or 85% as much as, or I should say 85% of their original list price versus 15% less. You know, during the peak of the bubble, not even 95%, couldn't even crack 95%. Easily cracked 95, then 97, then even 99%. I do expect this to level out a little bit. I don't think we'll go right down to 95 or 96 because of the ongoing strength, but maybe we'll start to see some 98s, maybe high 97. So look for that change kind of moving into this year. All right, month supply of inventory, metro wide for million plus. Golly, 3.8 months of supply. This segment used to have 30, not 13, 30 months of supply. This segment is used to having, 9, 10, 12 months, 13 months of supply, right? It's pretty used to that. What is absolutely insane and exceptional is 3 months of supply of million plus homes. That is a seller's market. Forever, this segment has been a buyer's market, right? We saw that where buyers are able to offer, 92, 91, 90, 95, because it's had 30 and 12 and 9 months of supply. And all of a sudden now it has 3 or 4 months of supply. And oops. And that's why buyers are having to get to 98, 99% of list price, and why that's happening in 20 to 23 days, right? Because supply and demand are really tight in this segment. All right, InfoSparks, we're going to skip it, guys. I think most of you get it. I just wanted to do a quick 5-minute demo. In the interest of time, we're going to skip it, but really encourage you guys to check it out, play around with it. It is a wildly powerful tool. All right, quickly, rates and inflation. What is inflation? Too many dollars chasing too few goods. What was $10 last year could now be $10.60 this year. That would be that would be the 6.5% rate of inflation. We've cooled down from 9.1 or so down to 6.5. So good news, but still high. Supplies, the trouble's on the supply side, right? But the Fed is operating on the demand side. Inflation adjusted prices, won't spend a ton of time here, guys. Just know These are nominal prices in red. This is inflation adjusted prices in blue. You'll notice we are well above bubble levels when you include inflation. Look at this though, blue real home prices, when you take out inflation, you'll notice we're actually not that far ahead of bubble levels, really. We're not, leaps and bounds ahead of those levels. Another way to look at this, so this one was in constant $03 moving forward. This one is in constant 2022 dollars moving backwards. So here the gap was kind of in front of us because we started at the same point. Here the gap was behind us because we ended at the same point, if that makes sense. Let's see, guys. I want to skip ahead a little bit. Let's talk rates a little bit. 30-year fixed 6.3. I know that was a little, maybe a week or two ago now. And so, I want to show you guys, we talked about that 18% in the early 80s. You guys can also see, that decline, that downtrend we've been on for a while. You can see sort of the exceptionally low rates and the ZIRP, or zero interest rate policy. Well, ZIRP's been around for a little bit longer, but, it really, rates really dipped low during the pandemic, including on mortgages. But let's zoom in. Let's not look at so much history, as much as I love looking at the history. Look at 06, guys. Prices are way higher now than they were then, but that was the last time, sort of peak of the cycle, last time prices were at their peak. Look, rates were 6 3/4, right? In 06, rates were 6 3/4. Well, we did touch 7. Now we're down to more like, low to mid 6s. And yes, we were sub 3% for a while. I find this interesting. I am personally of the belief, and I'll say personally, this view does not necessarily reflect the view of Mar. I'll say personally, I do believe that we should have been on the normalization course, or the rate normalization path for a while. I think we should have started it a while ago. So, had we done that, well, maybe we'd kind of be where we are. So maybe we're not that far off course. I think it just felt so dramatic because we had gone down so much and now up so much. If it looked more like this, I don't think it would have been felt quite as much. Okay, so this one is a big duh. I knew that. Yes, there's an inverse relationship between rates and sales. When rates are down, sales are up. When rates are up, sales are down. I'll take things that are obvious for 800, Alex, and that's the daily double. But I know this is a little obvious, but I want to visualize it nonetheless. And this is our local, I should say, our regional data for the 16 county metro. So change in the 30-year fixed rate mortgage in blue. So mortgage rates up, sales down. Mortgage rates down, sales up. Mortgage rates up, sales down. Look at during the pandemic, mortgage rates way down heading into 2020, 21. So sales up, and now rates way up, and so sales way down. You can kind of see this inverse relationship. Yeah, we have seen a little bit, we have seen some positive news here. There does seem to be some momentum in the right direction. You guys can watch the 10-year treasury. The 30-year fixed rate mortgage follows the 10-year T-bill pretty closely. All right, affordability. Median income needed to buy the middle home, or I think Dr. Lawrence Yun of NAR, we should call this the median priced home. Wow, that income has jumped pretty noticeably. Locally, our affordability index is below bubble levels, unfortunately. Don't overthink this, guys. Higher levels, better affordability. Lower levels sort of signify deteriorated, or sort of worse off, lower affordability. Peak of the bubble, prices were high, rates kind of got high, so affordability not great. Into the crash, prices went on sale and rates went way down, so affordability was excellent, terrific. During the recovery, right, prices started to rise, so affordability kind of normalized and moderated a little bit. But let's focus on really the last 2 years, and maybe I'll just zoom in. Let's really hone in on the last 2 years. So, really, oops, I guess I can't use my laser if I'm going to zoom. Well, let's just stay on my laser for a second, guys. So look, here in 2021, affordability really came down because of the price gains. Prices really started to just rally at levels way above their norm, well above average. So that really harmed affordability then. It was price driven. Last year in 22, what really harmed affordability was rates. It was really rate driven. And it wasn't only rate driven. Now at those higher rates, we really felt the effect of those higher prices. That was harming affordability in 21, while it was really rates in 2022. So year over year percent change in principal and interest payment. Look at this, guys, up 60%. Up 60% in your monthly PITI payment. This is national. How about local? I should say regional. So in 21, we went from a typical payment on the median priced home of $1,800 a month to more like $2,500. That is a 36% increase. We are not 60%. That's national. So that's influenced by some coastal markets and some other markets. We, believe it or not, we are more like 36%. I always like to do that analysis at the local or regional level. So that's a dollar amount, right? That's a dollar amount. What about as a percentage of income? This is pretty interesting. So that would still only be taken up a little over 26% of our pre-tax median income. And by the way, it would be that's if incomes are flat, you guys, which they will absolutely not be. But we don't have that 2022 income figure yet. So it would actually be 25.3%, assuming 3% income growth, which is going to be pretty modest, right? Just because of inflation. Remember, 3% income growth minus 7% inflation is a minus 4% real income growth, or I should say income decline. So assuming even modest growth, we'd be at 25.3, which is still above, 06 levels, but it does sort of put this in context, and it does sort of put, kind of wraps this up a little bit, and well, like the chart we saw earlier, earnings grow, but housing costs are relatively fixed, at least once we get in, right? Year over year for the market, of course, housing costs rise along with prices. So again, just another data point, another thing to kind of think about there. So what am I to do if I really need to keep my payment right around $2,500 a month? What's a person to do? Well, at 6%, if you're looking at keeping your payment at $2,500, you can afford a $420K loan. So you can borrow $420,000 at 6%, right? And your payment will be $2,500. But if rates go to 7% and you still want to only spend $2,500 a month, well, now you have to decrease your loan amount to $380,000 at 7%, and that'll keep your payments at $2,500. But at 6% to keep our payments at $2,500, we can afford a $420,000 loan. I know you guys know this. I know you've seen these. You get it. It's just a handy, again, another tool in the toolbox to use with your clients. First-time buyers, kind of been an average 30 to 40% for a while. It was 50% when the entire market went on sale in 09 and 2010, right? A lot of first-time buyers there. Definitely see an increase in first-time buyers, even though, overall it's kind of been on a downtrend. Saw a little bump, little spike, as everyone and their mother and their tax accountant and hairstylist all wanted homes. So we saw that increase. And then unfortunately, a little bit hard to see here, but we do see that first-time buyer share decline pretty notably to 26%. That's the lowest figure that's on record in 40 plus years. Guys, we have a standoff, right? Sellers think they're going to get offers over list like it's 2021. And buyers think they need to get a 2008 style deal to make up for these higher rates. So we have a standoff and no one wants to draw first. All right, few words on the economy. They say economists have predicted 17 of the last 3 recessions. I always love that one. I always get a kick out of it, but I think this time they're right? This time they're due for it. We are the body that dates recessions has not called one yet. It's possible that they will call one that started in the fourth quarter, or that started at the beginning of this year, or it's possible we won't see one until the middle or end of this year. It's also possible that the Fed does engineer this elusive soft landing, and perhaps we never technically dip into technical recession. I would say most folks think that's unlikely, but it's a possibility. I will also note that, we did have 2 quarters of GDP contraction. That is not the only figure that indicates we're in recession. There's actually a whole host of other data points that I think it's a subset of the NBER, the National Bureau of Economic Research, or maybe it's Economic Researchers, and I believe it's the Business Cycle Dating Committee, something like that, where they're the ones that date, or cycle dating, they're the ones that date these recessions, and they call recessions, and they use a whole host of inputs to make that call. So no, that was not just changed. Despite what you might have heard, there is a whole host of factors that go into that. One of the factors is jobs. We continue to have job growth, right, in payroll jobs. It is not typical of a recession to be adding, 250,000 and 500,000 jobs. That is not typical. That is extremely atypical of recessions. So while we've had growth in payroll jobs and are at a record high, we're still kind of below where we'd be if we stayed on trend. So there's still a little bit of a gap here. And, I think that's worth pointing out. Unemployment rate back to record lows. So economy is tight, labor's tight. Ask anyone whether they're, kind of regardless of what field or industry they're in, but especially in certain sectors of the economy, labor is tight. Good workers are still tough to come by. Who has the lowest unemployment rate of any major metro in this great nation of ours? I'll give you a hint. You're sitting in it. You're in it. Right here. Minneapolis, St. Paul, Bloomington, Twin Cities metro area has the lowest unemployment rate of any major metropolitan area, right? So 1.9%, an extraordinarily tight labor market, right? Followed by some of the other folks, Salt Lake, Miami, Birmingham, perhaps surprisingly, San Jose, perhaps surprisingly, Jacksonville, Kansas City, Indianapolis, Nashville. I was just in Nashville, very cool city. Atlanta, Boston, Columbus. You guys can see some of these other regions, but we are the hottest labor market in the nation. Some of you might be surprised by that. It's a fact. That's what I love about facts. Facts are true and factual, whether you like them or not, whether you believe them or not. That's what makes them great. Some regional differences, job growth, kind of October 2022 versus March of 2020. See some growth in the Southeast here, in the southern states and sort of the mountain states here, especially Utah and Idaho, and then even some growth in our among our friends on the West Coast there. South Dakota, I guess, doing pretty well, along with Montana. Us and some of our friends in the upper Midwest here, as folks really made moves, especially baby boomers, they were really thinking about kind of where they want to be and longer term moves, and expected 10 years up. So we expect to spend more time in our homes, than we have. And so I think weather does have a lot to do with that, believe it or not. But also, tons of other factors, the usual factors, affordability, job growth, incomes, you name it. Yeah, mortgage delinquencies, 90 plus days, not a ton here, guys. Just know, Lawrence, using MBA data, calls this imploding mortgages. I kind of puts a fine point on it. And then during the COVID lockdown period here, where you see obviously an increase in delinquencies, but most of those folks have come off forbearance. So, well, let me just tie that up with a bow. Not a ton of concern here. Not a ton of concern here. Any of you expecting this huge influx in foreclosures, we'd have to first see an increase in mortgage delinquencies, and we're just not seeing it, right? We're just not seeing it. Retail sales since the end of the last recession. Let's skip this one, guys. Let's just go to the big four, and this includes employment, industrial production, real sales, and real income. So you guys can kind of see years since the 2009 trough. That would be the COVID market there, or the COVID disruption. but we can kind of see, going through November, some pluses, some minuses, and kind of how these different indicators are behaving. Sort of the aggregate, I like that this takes all of those in the aggregate. Let me zoom in on this one. Gets a little hairy to see. So this was the Great Recession, right? Kind of coming down, took some years to get back. This is the COVID recession. Very sharp V, hard pullback, but a hard recovery. And then this was the sort of bump that we saw, right? So 2020, 21, 21 into 22. This was the bump that we saw in, goods consumption, Amazon trucks all over, people ordering stuff, stocking up on toilet paper after that. And then you can sort of see us turning a corner just a little bit. There are some signs, some signs of, fissures around the edges. Jobless claims have risen to a 3-month high kind of at the end of last year. So I think that's worth pointing out. And other signs of a slowdown, the bond market is still sort of yelling, we are concerned. The yield curve is still inverted, where yields on 2-year debt is higher than on 10 or 20-year debt. Stock market, a little bit of good news in the last week or month or so, but still struggling. Let's see how the earnings, this earnings season goes. Let's see what the Fed does tomorrow. I think they're making their decision on rates. Hopefully a 1/4 point over a 1/2 point, but they may feel compelled to signal to markets just how serious they are. We see some layoffs and some other indicators. Again, it's possible we're in recession. It's possible it won't start. It hasn't started yet. Truth is, nobody knows. It is possible we have a soft landing, but some think it is. It's a little bit less than likely. Yield curve inversion, another kid stories, just in case you wanted to geek out on that. All right, guys, we're rounding third base. Age of home buyers and sellers, silent generation all the way up through Gen Z. I have added a generation. I call them the coronials. I have two myself. But this mini baby boom coming out of the COVID era, I call these babies coronials. Some of you might have heard of a silver tsunami. 10,000 baby boomers retire every day. So there's a lot of you out there, a lot of them, a lot of us, a lot of baby boomers out there. Silver tsunami, surfing the silver tsunami wave. Seniors, there are lots of them. They feel stuck in their homes. These homes are paid for, right? But they don't really have anywhere to go. Whose fault is that? All of ours, right? Shame on us. Right, in the construction industry, the policy arena, our lending and financing and legal, we haven't figured out a way to build the single level townhomes that seniors and boomers need. They don't want to deal with snow and lawn. They don't want to, trek up and down stairs. They're okay with having that lofted area for the kids or grandkids or what have you. But they really want kitchen, bath and bed and everything on the main. So yeah, they're stuck in $350,000, 3,000 square foot house with 5 beds and 3 baths. They need 1,400 square feet with 2 beds and 2 baths. So this sort of speaks to, the housing chain or housing ladder, where different rungs of the ladder sort of seize up because these folks aren't moving off their rung. So no one can kind of come in and start climbing up that rung. Hey, buyers, what's up with you? What's going on with you guys? What are you doing? How are you adjusting to some of these changes we've seen? Well, some are buying smaller homes. Some are adding others onto the loan with them. Some are choosing to buy down rates. Others are waiting and seeing. We'll talk about why that may not be the best option. Stretching budgets, paying down other debt, a little bit less down. ARM share of repurchase and refi loans, seeing a little bit of an increase in adjustables. Square footage, right? We needed bigger homes in 2020. 2%. I suppose that is the largest increase in 10 years. So, pretty notable increase here, as we all needed an extra bedroom for an office or classroom, and so on and so forth. And then kind of pretty much back to pre-COVID levels, 2019. By the way, as you see more new construction homes sell, we know that new homes tend to be bigger. So as you see more of them sell, expect size or square footage to grow. Median age of home buyers. This one is also a little bit disappointing. All buyers light blue in the middle, first time buyers dark blue, repeat buyers median blue up here. It's crazy to me that first time buyers used to be 29, and then your move up buyer was 36. Now your first time home buyer is 36 and your move up, or well, actually these are downsizing, repeat buyers. I shouldn't say all move up. Some of these are downsizers. I'd even say most of these are downsizers, but now it's 60. So it used to be first home at 30 and then moving up at 36. Now it's first home at 36 and moving down at 60. Wow, how that has changed. So pretty interesting. Look at heading into the crash, 08, 09, 30-year-olds could buy homes because prices went on sale. And then as prices have risen, age rose 31, 32, 33, especially last year, you guys. This was really a dramatic change from 33 to 36. We talked about this one, just a better way to look at it. 26% first-time home buyers, lowest since 81, and really a pretty dramatic change. Location of home purchased. Suburbs used to be dominant, still dominant, but from 50 down to 40%. And what came up? Small town, believe it or not, rural areas even. Urban central cities down, tick down a hair, 13 to 10. And then resorts or recreation areas, sort of interesting, 4%. You've seen growth there. Anybody working from the cabin today or looking to move to the Brainerd or Lakes area up there. Method of home purchase. This one's interesting. Through a real estate agent or broker, right? 86% still using professionals like you guys. Directly from the builder or builder's agent. That was pretty interesting to see that decline. I guess I rely on some of you to tell me, some of what happened. I guess I have some ideas, but I'd love for you guys to share thoughts on that one. And then this is interesting too, directly from the previous owner. This ticked up to 10%. Even though, agency representation didn't really tick down, it's been pretty flat from, 86 to 90 for a while. But that is an interesting one to kind of watch. Oh my goodness, here's a fascinating one. Distance between home purchase and home sold or previous residence. Used to be, 10 miles, then it was kind of 15 miles, and all of a sudden it was 50 miles. Well, we just saw that folks are moving from, suburbs to more small towns or, recreation areas. So that makes sense. Okay, distance between the home purchased and the previous residence. So there's your 50, 15, 15, 15, and 50, just kind of another way of looking at it. Buyers who finance their purchase. Repeat buyers, 83% down to 73. When rates doubled from 3 to 7%, I'm going to use cash if I've got it. Speaking of cash buyers, percentage of all sales financed in cash, 15%. Last year, that's the highest level since 2014, right? That makes sense. I'm going to use my cash. It didn't make sense to use my cash when rates were 3 or 4% and the market was returning 8 or 10%. Let your capital work for you in the market, earning 8 or 10%. We actually even had some 20% plus years, and then borrow at 4%. So your money's earning 10%, you're borrowing at 4%. That's a 6% spread. But now, if your home will only appreciate maybe 3 or 4%, but you think you're going to borrow at 7%, or the whole market's down, 15 or 20%, I'm talking equities, the Dow and S&P and NASDAQ, all down 15 to 20%. Well, maybe it does make sense to use your capital to offset those interest charges or those interest payments, I should say. Percent down payment, not that exciting here. First-time buyers still about 7%. Repeat buyers closer to 17. We do not yet have 2022 for this one. I think it is out, but I will work on getting that updated. Median seller tenure, 6 years, long time. All of a sudden it was 10 years. And then everybody moved and it was 8 years. And now rates are higher and everyone wants to keep their rates. And now nobody wants to move. And so we're back to 10 years. Median expected tenure. First-time buyers, right? 7 years, then 10 years for a long time. And all of a sudden, now they're thinking 18 years. So what, you guys? So what do I tell my clients? So things are in flux, right? You still need a place to live. Rents are rising quickly. Your housing costs are mostly fixed, right? We talked about that. Things remain very much rate dependent. Waiting probably won't make sense. You're probably going to trade an interest problem for a principal problem then. And if rates do go back down, you know, you're going to wait for rates to go back down. Well, then you're going to be in multiple offers competing, you know, with someone, and the $400,000 house is going to be priced at 425. Also, the sky's not falling. Inflation and rates are already heading in the right direction. So believe it or not, now may actually be the time where you have more leverage and negotiating room. Prices are unlikely to fall significantly. They could kind of, you know, they could falter a little bit. We're not really forecasting that. What is likely is that they'll increase much more slowly moving forward, which will give incomes a chance to catch up. Moral of the story, the best time to buy a house is when you're ready. Saw this one from my friend Marky Lemons Ryle. AI will never replace a realtor. However, a realtor with AI will replace a realtor without AI. Matt, first comment, or well, most relevant. I've met some that don't even have regular eye. Why is that the first comment? We have to fight this, you guys. The way we're going to fight that is by upping the professionalism bar and by making you more familiar with and more comfortable with the market stats so you can use them to grow your business, help your buyers and sellers get more referrals and repeat buyers and sellers, and everything that comes along with it. So, you know, this is sort of a joke, and we kind of laugh at it, but, I really do want to say this year, let's think about upping our game and really driving home, just how much professionalism matters and how much the numbers matter to helping, folks make the best decision and so on. In Mandarin, the word crisis is made up of two characters, and individually they mean danger and opportunity. In times of change, there are threats, but there are also opportunities, right? So we try to manage the risks while pursuing the best opportunities. That's kind of my version. Hopefully you've got a better sense of sort of where things are, and maybe heading. So I sometimes like to say adapt or die, right? You're either green and growing or ripe and rotting. And I'll use the cliche, skate to where you think the puck will be. I also always say knowledge is power. So, share this with your agents, your friends, your brokers. If you're a broker, share this with your agents. If you're an agent, share this with folks on your team or your clients. So regardless of a shifting market, right, you can still have a successful business. You cannot control the wind, but you can adjust your sails. And with that, I'll stop in the name of love and open up for any questions. Seeing none, I will thank you so much for your time today. Really grateful that you invested the time with us today. Hopefully you learned a little bit. Please feel free to reach out if you have questions or thoughts. We will absolutely send slides out so you guys can have those and spend some more time with them or use them on social media or mailers, etc. Thank you again. Use the data for good and never for evil. And please join us again next time. Thanks, guys.